Hello everyone, and welcome to today's lecture in our derivatives course. We've already discussed buying call and put options. Today, we will explore the other side of the trade, writing a call option. By the end of this lecture, you will understand what it means to write a call, its features, why investors do it, and the risks and rewards involved. Writing a call option means selling a call contract and taking on the obligation to sell the underlying asset at the strike price if the buyer chooses to exercise. The writer receives a premium for accepting this obligation. If the underlying asset's price stays below the strike, the option expires worthless and the writer keeps the premium. If the asset's price rises above the strike, the writer must sell the asset at the strike price, even if the market price is higher. Let's examine the main features of writing a call option. First, the obligation. The writer must deliver the asset if exercised. Second, the premium. The writer earns this amount up front. Third, limited profit. The maximum gain is the premium collected. Fourth, unlimited risk. If the underlying price rises significantly, potential losses can be very large. Fifth, variations, covered calls, where the writer already owns the asset, and naked calls, where the writer does not, exposing them to much higher risk. Here's an example. Suppose stock XYZ is trading at $50. An investor writes a 1-month call option with a strike of $55, receiving $2 per share as a premium. Since each contract covers 100 shares, the writer earns $200 up front. Scenario 1. If the stock stays below $55, the option expires worthless and the writer keeps the $200. Scenario 2. If the stock rises to $65, the option is exercised. The writer must sell at $55 even though the market price is $65. The effective loss is $10 minus the $2 premium, or $8 per share. For 100 shares, that's an $800 loss. This demonstrates the risk profile, limited upside but potentially large downside. So why do investors write call options? For income generation, writers collect option premiums, especially in stable or bearish markets. For covered calls, investors holding stock can enhance returns by selling calls against their holdings. For speculation, writers who believe the asset will not rise much can profit from time decay. But remember, naked call writing carries unlimited risk, and even covered calls sacrifice upside potential. In summary, writing a call option is a neutral to bearish strategy. It allows investors to generate income by collecting premiums, but the trade-off is limited profit and potentially unlimited losses if the asset rises sharply. Covered calls provide a safer way to use this strategy, while naked calls require extreme caution. This concludes our discussion about writing call options. See you at the next lecture.